Hey traders, hope you're all well. Now, this isn't a comeback video, this is more in response to some of the emails that I've received in regards to consistency with both Forex and binary options trades. Darlene, this is for you. And so I thought I'd create a video and run through everything. We'll probably do some analysis in this video of all the currency pairs that I've got in the bottom of my screen as well um, of this week and where you would have taken your entries. And we'll talk about reasons as to why you're probably unable to be consistent. Okay, and I speak from a lot of experience here because I've been burned so many times. Okay, I want all of you to start to understand that the primary reason why someone is successful in trading as opposed to someone who is new to trading but isn't so successful is just simply that the person that is now successful has been burnt a great number of times, and they learn to keep things simple. They learn to only take select few trades at the most optimum setups, and that's what gives you your consistency. Um, Over time, like with many traders, when you're looking at so many different types of setups that are happening, and there's also different types of strategies that apply as well, that we start mixing and matching various things, and before you know it, you're more frustrated than you were previously simply because things go well and then things don't go well and then things go well and then things don't go well. One person in particular started off with a I think it was a £500 account or $500 account or something. Market moved, they lost a bit of money and then they gained back and they were at about 660 or so. And then I think over the course of the last 48 hours, they lost 160 of that and came back to the starting point as to where they were a few months ago. So there was some disappointments there. And Dave, this is for you, man. Don't be disappointed with that. Learn from that. That's the most important thing, and that's the only way you're going to be consistent. Okay, so that's one. Mixing and matching strategies is completely wrong. We'll come back and I'll show you exactly what I mean by that. The other thing is where traders are trying to fit setups into unfavorable conditions. Okay, for example, we've got a quite a substantial move with Euro USD this week. But if we zoom in here, and I think this is where Dave had the problem yesterday. Here's where he saw an M pattern formation in mid to late Asian session, right? And then this market moved down, and he was following my advice to say, if you're not entirely sure, wait for the market to move more so, and then once you've got like a strong confirmation candle, take your entry. And I believe this is where he took his entry, right at the bottom here, right? And then the market went up, and I think he said somewhere about jumped out at the middle of the second green candle. So I assume somewhere around here. Now, mate, don't feel so bad about it. I've made that mistake plenty of times. I still remember a time when I actually had done this sort of a trade, and I had dumped 10 lots at the very bottom of where the market would have normally bounced off of. And I lost, I think, something like 2K that day because I kept wondering what the hell was going on. So don't feel bad about it. Now, we make mistakes, and this is the importance of kind of demoing your setups before you start doing them live. When I say to you guys, demo on this, I'm saying this because I made that mistake plenty of times of trading on live, right? Live accounts. And yes, a lot of the times this is how we learn. But like I said, going back to point, where we're trying to put setups in unfavorable conditions. The M's, the W's, the double tops, and the double bottoms, yes, they all apply, they all matter, but it kind of matters as to where you place them, right? So, and someone has been asking me about the MMM method. Can I just quickly say, the MMM method is not a specific method that someone just created. Um, it ties in with a lot of institutional trading as well, know-how. I was taught this sort of stuff back in 2002, and it all ties in with Elliott wave structure. Okay, when we're talking about the different levels of rise, when we're talking about double tops and double bottoms at key positions, we're talking about them in tying it with Elliott wave structure. So just quickly, if we were to say this was market was coming from X, right, and then what we've got here is the first climb, correction, climb, correction, climb, right, and we'd say this is 3 levels of rise. Okay, this is Elliott wave structure. So we've got here, which is the first level, and then we've got 2 here, 3 here, 4 here, 5 here, right? And after 5, we've got some corrective waves that tend to happen. Now, just through experience, we start to discover that a couple of things tend to happen consistently. The first one is at these junctures here, we would get a double bottom or a triple bottom formation, most likely. If not, we'll get a head and shoulders pattern, most likely. Okay, we can get a very sharp V bottom, most likely as well, but it'd probably be something like this. This is where they tend to apply, and this is where we want to be able to trade them, right? For all extents and purposes, this sort of movement here is what's going to trigger, say for instance, when we're seeing the EMA 50 do this, and so we've got the 200, and we say the 50 is just crossed above the 200. This is where you'll see it, where you'll see this double bottom, triple bottom, head and shoulders, V bottom pattern happen somewhere here. And this is kind of for more advanced traders where you can actually see this happening, right? Now, for the rest of us, when we apply the simple Forex strategy, what we're doing here is we're looking for this climb to kind of complete, right? So this goes up. This is where the EMA 50 crosses above the EMA 200 and starts to do its thing, right? So price goes up, and then it consolidates. Now, the consolidation that we're talking about is this. There's this mark here, because sometimes it's like this. Price will go up, and consolidation will happen like this. And then you'll get another double bottom, a triple bottom, head and shoulders pattern, a V bottom, or something along those lines happen here before the market goes back up again, right? And then what we're expecting, Elliott wave structure would say that this most likely will come back to 618, and I kind of make differentials on that as well, and be probably a 382 hit. Sometimes it might come back to 50, but if it comes down to a 618, and then we've got an aggressive candle going up at, say, London Open, New York Open, fantastic time to be taking an entry. Okay, and if we've got news or there's significant volume, something that's moving the market, even better. So this market's going to rise up. How far is this going to go? Most likely, if we've got this structure correct, that cross, we can possibly take an entry here and let that market ride till 1618 of our Fibonacci expansion tool, right? So if you were to go to, say, insert Fibonacci expansion, and you drew your line in from 0 to 100 line here, then this would, okay, let me do this. It's not going to line up exactly. So this would, if I put my 100 line here, this, hey, oh no, didn't draw it in properly. This should say that price should go all the way up to 1618 line. That's what we can kind of project to. Okay, so again, Elliott wave structure. And then when market pushes back down again, this is where market's gone. It's probably, and mind you, one other thing, guys, that this hit, this double bottom, triple bottom, probably will be happening somewhere close to your EMA 50 or your EMA 200. Okay, and that ties in with our simple Forex strategy. So once it happens there and market moves up, fantastic. What are we expecting? Another impulse wave going up, and then we've got some corrections happening. Market comes back down, and we're expecting this to come back to our EMA 50. And guess what? Once again, to give us some sort of pattern, W pattern, a triple bottom, a head and shoulders, or something along those lines, right? Here, you'd most likely get variations to a double bottom pattern, right? This is where you're most likely to get a head and shoulders or maybe a triple bottom structure. That will happen more so over multiple sessions. Okay, so that's what we're kind of expecting. And even here, you can expect to see market just kind of consolidate over multiple sessions or even just range, right? Before it creates some sort of a pattern we were expecting. So here, I would only be expecting that this market will create a bit of a false move south, a wick to the low, or something aggressive move up. When I get the aggressive move, now remember, these patterns mean absolutely zilch without my confirmation candle. I need my confirmation to get the hell out of this area, which to me says that, market's moving and I'm going to go up. And this is where simplicity comes into it. It's where you say, I'm going to take a break, I'm going to have a coffee or something, and let all the other traders squirm for the market to do its thing for a while before it starts to move. And you really only want to take your entry when it moves, because when you know psychologically you're going to get stressed if the market goes against you for 20, 30 pips. Okay? And what's important here also is to know that, excuse me, I'm about to sneeze. Okay, so what's important here is to know as to the type of trader you are. Are you a longer term trader, someone that forecasts and projects outward, or is it just someone that's in the game for 20 pips, 30 pips at a time, 2 or 3 times a week? Your lifestyle trade. To figure that one out for yourself, because the strategy that you will apply will be catering towards the type of trader you are. You can't just simply jump into the Forex market and start mixing different things because you say, hey, I'm seeing this here now, so I'll take this sort of an entry. And I guarantee you, because over time, you will settle into something, and if you don't, you're going to be losing trades and winning trades and losing trades and winning trades. Okay? Take it from someone who's kind of learned that, and a lot of the successful traders out there, they've learned that the very hard way. Okay, so this is where you're looking at for your triple bottoms or your double bottom formations. Where would you be looking for your M formations within the whole mix? It's here, right? So when the market's going up here and it's reached its peak as to the first wave, you look for a double top formation or a triple top formation, right? And then the market comes down. How do we know that this here, and I think that's one of the questions being asked as well, how do we know that this is not going to now keep falling as opposed to come down to a certain point and then move back up again? It's because of our Elliott wave structure analysis that we did here. Okay, it's to say when we see this and we're seeing the EMA 50 and the 200 cross, well, if it's going up in that direction, we're expecting that this market's going to reach a certain point, create that 100% movement for us to begin utilizing in our analysis, and then to say create a structure and then come back. How far can this come back? Well, if we use our fibs, we'll say it can come back to 382, it could come back to 618, or maybe the 50 line here somewhere. Okay, if it comes back to 618, then and then moves aggressively up again, then we know at that point in time that this market is possibly in Elliott wave structure, and this is heading towards 1618. And what you could also do is wait for the market to break this high before you look for an entry. Okay, sometimes what you might find is that this is going to break this high, go up, maybe hit the 127 line, come back, do a retest, and then go up to the 1618. And once it does do the bit of the fall that's coming down, draw a support line off here, and see if the market does come back here. It comes back, hits it, does an aggressive move going up, take it. Okay, that's your confirmation. This is going to go all the way up to the 1618 line. Okay, and let me just draw that in for you guys. So if we're drawing this in, right, so this here is the one, this line here is the 100% line, right? Market may go up to the 127, come back, do a retest of it before it starts to climb. Once it's climbing, you can take an entry anywhere here because you know that this market is potentially going to go to 1618, right? And then you've got the potential of about 38 pips there. How much are you trying to get? 20, 30 pips at a time. So that's your confirmation, that's your entry. And that's how we kind of keep it simple, right? So before I make more of a mess of this chart, let me just quickly fill you in again. So here is another M top or a double top formation. Market comes back down to the 382 mark and then goes back up again. Once this market is up here, we're expecting maybe multiple sessions worth of hits to a common high, right? And then market comes down and does some sort of correction, right? This is also not a confirmation for us that this market's heading south. This is a correction. It's only when we find that the 50 probably breaks past the 200 again after this point here, and what we might find is that price will do this thing and then go up here to 618 on Fibonacci line of here before it falls again, right? So when it does that 618 hit, it might most likely come back to this EMA 200 to fall. And that's when we say, okay, this market is now heading south, and that's when I look for my entry going south. Okay, so hopefully that all made sense to you guys, and that again reiterates the point of knowing when to apply your M's and your W formations. And I can't remember who the person was that asked about, excuse me for a sec. So I can't remember the person that asked me about the MMM method stuff. The three levels structural movement is everything to do with Elliott wave structure, and there have been a lot of methods out there that have been built around this. We want to come back to simplicity, okay? So we'll look at it that way. The last one that I think is a major problem when it comes to people trading and losing or not being able to be consistent has a lot to do with not following criteria. Okay, not following your criteria as to when to take entry, and then also messing up in ignoring your reasons as to why you shouldn't be taking the trade. All right, so let's just focus around that bit, the entry. So you've got your setup in unfavorable conditions, you've got mixing strategies, and then you've also just got just messing up the entry completely. So say for instance, you were at the bottom here where your Elliott wave structure was starting, or right at the top here where the market is starting to reverse. And say for instance you've got, say, the structure right, the double bottom, triple bottom, double top, triple top, all of that is accurate, and you just say, okay, this market's heading south. And this does tend to happen when you take your entries off your higher time frames, because you'll probably just take that entry and on a candle like that, say for instance, jump onto daily chart. Okay, zoom out. These here consistently, this movement here would have given to us this movement here. This movement here from this point to this point, right, is, I'd say, this candle here, correct? If we were to look on a daily chart and we say, yes, you know, this market's moving up, and we'd take an entry right at the open of the next day. So let me just drop a line so I can show you on a 15-minute chart. Zoom out. So this is where we're at. Okay, so this would have been the peak of that green candle on the daily chart. Markets moved down. There's been a number of times where the market, or for a while there, primarily throughout the Asian session, the market stayed below this line. And so what that would have meant is, see this wick on the daily chart? Zoom in. See this wick here? That is this whole entire time when the market has been below this line here. Okay, and for us that is, what is that? So it's about 10 pips, almost about 10 pips out of the money. So when we jump into, say, a trade on a higher time frame, we're just jumping in because we're thinking, okay, this is going to happen. We actually have to absorb for whatever time period the false moves that are going to happen against us. So in this case, what could have happened also was, if I drew in my fibs, is that price could have just come back down to, in this case, it didn't even hit 382. It could have come back down to 618. So if we would have taken the entry straight off there, the market would have probably come down 37 pips out of the money before it went up, right? And so this is where knowing the type of trader you are will apply. And this is where risk reward comes into play as well. This is where um, truly measuring your stop losses come in as well. And for the longer term trader, yes, they would have made a bucket load of money through this because there's about 300 pips in that mix, right? But they also do run the risk of being emotionally withdrawn as well for that period of time, because here, this is a great number of hours, probably about 6 hours, for the market to be out of the money for that person, and also the potentiality of the market falling back to 618, which would be about 30 something pips out of the money before that market continued going up, right? So this is where they'll say, okay, I'm going to risk 50 pips to get my 300 pips or something along those lines. But you've got to figure that one out. For our extended purposes, we wouldn't be doing that because we're only trying to capture 20 or 30 pips at a time. So what we would be doing is be looking for ideal entry where we don't have to sit there and be out of the money for 6 hours, or be substantially out of the money for a longer period of time before this market hits a fib point and then climbs, right? So what we want to do is to perfect our entries on a 15-minute chart. And look, and for those of you that do trade off the higher time frames, if you want to kind of improve on the quality of your trades, certainly go into a lower time frame to take your entry. Do your analysis on higher time frames, but go into a lower time frame to take your entry. Okay, very, very important. And then just going back to the daily chart, this is something I haven't touched upon, which I think is also important. When you take note, another question that was asked about the different structures, the patterns, doing it on a 1 minute chart or a 5 minute chart. Look, everything we talk about when it comes to Forex and for binary, it can happen across all time frames, right? It's just on a higher time frames, the market respects those structures a lot more. So you might see a lot of M patterns on a 1 minute chart, but the market just really doesn't move in that manner more consistently, or as consistently as you would have expected. Whereas on a daily chart or hourly chart, even a 15-minute chart, you're more likely to get respect of those patterns. So you're better off just kind of trading in that regard, right? So when you're looking at, say, directive movements, in this case, where you could have seen this as a bit of a retest of the EMA 200, and what we're kind of also honing into is the specific types of like candlestick patterns that that do the retest for us. One in particular would be a nice strong wick to the 50 or the 200, right? Like this here. A strong wick followed by an aggressive red candle gives us some indication. We probably would have had an engulfing pattern of this sort where, well, this isn't quite engulfing, but you'd want to have a lower close with a nice wick to the high or something along those lines that gives you somewhat of an indication, yes, the market's ready to reverse in this direction. My favorite are the evening star and the morning star patterns like this. This is not a direct one. It probably takes 4 candles here to give you that. But this aggressive move up here is an indication that this market could continue going up this way, right? And that's where we jump onto our 15-minute chart and we're looking at this cross. This move here would have been a confirmation, and that from this point here, what we're looking for is a couple of things. One, we draw in our fibs and say if the market does come back to 382 or 618, we're very happy. And if market would have come back to 618, it most likely would have possibly been very close to the EMA 200. But in this case, we didn't even get the 382 hit, right? So this continuation happens. And if you take note, we've got a quite a mix of colors here. So um, in real time, you would have been confused as to where the market's going, right? You could have traded that, but you would have had some degree of confusion. As opposed to here, where you've got a continuation process that happens, and you could have taken your trade from here somewhere, right? We've got this consolidation, wick to the low, take your entry here. So that's one way of trading that, right? Um, going off going off here, what we've got is a W formation. Now, areas where I certainly just, I'm wary or I don't take an entry straight off. One is if I've got my EMA 50 or my EMA 200 there, I'd probably want this broken. I want this retested. And then if it's very close to, say, the low of a session or a high of a session, so in this case, um, it's the low of the Asian session, I'd be wary of this. So what I would want is aggressive move coming south, breaking this completely, and the actual candle closing below before I start considering any sort of entry going towards the 200. For those of you out there where that are trading the simple forex strategy, I would just simply say don't take these sorts of trades coming back to the EMA 200. Don't risk them. Okay, wait for the market to come back to the 200 and behave a certain way. Either give you a double bottom setup or a triple bottom setup or something along those lines, and then go head up. That's what you trade. Or if it breaks the 200, does a retest and starts coming down, that's what you trade. These ones are a lot more riskier. So for more advanced traders to look at. Okay. Um, Sorry guys, I'm not really feeling too well. So yeah. Anyway, um, Euro JPY. Let's have a look at this. So this is kind of an example of what I mean. Thursday, Wednesday, Tuesday, Monday. Monday started off. Market did go for a climb. Market did go for a climb, and if you did not trade these at all, that's okay. Notice how here this is the climb. Market comes back to uh, hug our EMA 50, right? We don't trade Asian sessions much, okay, and we shouldn't, and that's another criteria, a rule that if you get some sort of setup, especially with a mixed pair like AUD/JPY or AUD/USD is a strong pair for us to be able to trade, and if we take it there, then yes, that's okay during the Asian session, but you won't have too much volume. So it's better for us, in the interest of simplicity, to wait for London Open or New York Open for us to be able to take a easy, simple trade. Okay, and in this case, I would have possibly waited until after this high here was broken to go up. Why would I have taken it up here and know that this market was heading up? Um, the reason was that this break happened on Monday, right? And then this is the first hit to our EMA 50 and 200, and also that during Monday, Asian session, the market did a cross of the EMA 50 and the 200. So I'm expecting at least one hit to the 50 and the 200, right? And can I just also just remember to go back to Euro USD and also just say um, it's been through experience where I realize that once this cross happens, before this market heads back towards the EMA 200, usually it takes about 2 or 3 bounces of the EMA 50. That's just being personal experience. Don't rely upon it, but certainly do the counts. So what I would count here is to say this really isn't a bounce. This is the market didn't even touch the 50. You could probably say that this here might be it, but not really. I would count this as a bounce off the 50 where it kind of comes and touches and firmly hugs it before it goes up. So I usually count about two, maybe three of those bounces before I expect that the market will come back to a EMA 200 hit. So that's probably another reason why you wouldn't be expecting this trade to happen, where the market's going to head south, going this way. Okay, let's look at Euro JPY again. So in this case, this is what I was saying to you guys. The market does reach a peak at some point, will reverse again. Would you have taken these trades coming down to the EMA 200? Maybe. Here's two hits to the 50, that one there and that one there, before the market comes back down to the EMA 200. So if you follow that rule, then chances are you might avoid some of the losing trades, hopefully. Okay. Now, markets come back to the 50. That's given us a wick down here. Is this going to be a climb? We don't know, right? So would we take an entry here? No. What we would be waiting for is this sort of behavior where the market did come, gave us a bit of a W formation, went, and then where I would have taken my entry, and this was yesterday. So I haven't really traded this week. Where I would have taken my entry, this is a bounce off the 200 that the market did. Remember what I'm saying? Very simple trades. We now know over the course of that previous 24 hours that the market's kind of on somewhat of a downtrend, right? We can probably look at the past as well and start drawing in fibs and say where the market might bounce from. But what we find also through experience is that fib bounces tend to happen around the 50 or the EMA 200. So once this market has done a bit of a double bottom, and again here, if you take note, a reason why we wouldn't be looking at shorting this market here, this is still at the low of the Asian session, right? Also looking at news, yesterday we didn't have anything significant. So 6:30 is about an hour and a half after London Open. We had some pound news, right? But beyond that, there was nothing really else for us to trade. So when the market is stalling, but it is creating lower highs for us, we're expecting, we can reasonably predict that the market's going to fall. We've got the 50 coming close to the 200 as well, right? So where would we take our entry? Now, another area where I've made plenty of mistakes is here, where I would probably take an entry at very close to Open of New York. And gradually what I've learned over the years is that it pays for me to wait, because a number of things can happen. This could come down, and if say the EMA 50 was up here somewhere, price would have probably risen back up to hug the EMA 50. So in all extents and purposes, I kind of wait for some sort of a behavior like this, and then continuation pattern. So where I would have taken my entry would not have been here or here, it would have been here. And that's because the market has come down. It's starting to show substantial moves in the direction of my trade, and then you go in here. I take that trade. Now that's 32 pips, which is beautiful in itself, and you can get the hell out of there. And that probably is just one for the day or the week, and you're gone. But what I also do, this is something you can try, is if the market is moving, and this happens, say, London Open or New York Open, where the market's really moving with you, you can begin to count candles. Okay, so this here, where this kind of, the low of this breaks below all of this, and I can draw a line for you. So that's the low of this, and you take your entry here, you can start to count candles in some way to say, okay, I'm going to count whatever this break is the first candle, that first part. I'm going to go in the second candle here, and I could possibly ride another candle. Right, so if you've got your 20 something pips, you can get out. In this case, at the end of this candle, given Euro JPY spreads as well, you'd have 30 pips in the money. You could possibly ride the next candle as well, right? And here's something I personally do. If I know that I'd like to collect more pips, or the market is going to move substantially, and how I can do that also is look at previous structure and see where there is support resistance areas. I probably would have looked at that and said, okay, market is somewhat slow. There's the potentiality of a pullback here, and also the market did move 30 pips here. Okay, just in one candle. So you might not want to take this right? But as soon as I've done that and I'm possibly hit 40 pips plus, at any point between that 40, 50 pips, I'd get out, right? And that is not. Some people may say, "Silly Shiva, you're riding the wave. Go for it," right? But this is all about consistency here for me, where I'm taking the easy trades, right? So here, where the market did a whole bunch of stuff, I could have jumped in anywhere, but I am second guessing myself. Whereas here with New York Open, you now know there's a very clear kind of a move going in a direction. We don't take it here because we're still uncertain, but we start to take it here where the market has moved substantially in our favor, and we're getting where people would have thought this is a W formation. You might say now this is a M formation, and another confirmation for us is when one of the peaks of whether it's a W or whether it's an M is hitting our EMA 200 or our EMA 50. So it's like saying again, if you see a pattern formation happening at your EMA 200 or an EMA 50, so double bottom here, one of the bottoms hitting the 200, or double top where one of the tops are hitting the 200 or 50. That's your confirmation. This is not a overly strong confirmation. This would be okay. Get in after that fact. Now, if we go through a number of currency pairs, that's exactly what the market had done. We've got no hits here. AUD JPY, we've got a bit of an evening star pattern before New York Open, but really nothing much. You can wait for a substantial move like one of these big candles before you can take an entry. Would I on this? Wow. AUD JPY, we've got 20 pips right there in this next candle. But you could make that choice to not take that trade simply because that's not doing anything specifically around your 50 or your 200, right? You've already got your 30 pips with the Euro JPY, so that's okay, right? Let's see AUD USD. Now, this is another key example of where we don't complicate our strategies. Zoom out and you look at all of this. You can go into higher time frames to work out what's going on. But if it's not making any sense, don't trade it. Simple as that. That's where we are trying to be consistent. If it's not making any sense to you, it's not doing something as simple as these sorts of moves, don't trade it. The other thing that I want you to look at, and here's the difference. When you see the market be like this, trade them. When you see the market be like this, don't trade them. These are very aggressive moves within the market. Don't trade them. Like you see it, run away from it. And I think Pound USD is doing exactly the same thing as well. USD JPY, here's another key one. Camp markets in a bit of a downtrend. All of this is lower highs that we're seeing. And then the market moves Asian session and we've got a ripple effect, which is a bit of like a range. So I drew these lines in. Didn't take any trades this week, but I have drawn them in. Now, this is where the market breaks this low, right? We're expecting some sort of consolidation and delay, maybe a hit to the 50 again. And this is, again, remember, in the interest of simplicity and consistency, we don't want it to, because this could have just been a doji green candle back up to the EMA 50 before market comes down. So I wait for this candle to finish. I go in here, and notice how there isn't a substantial wick on the top of this one as well, right? That's what we kind of want. Okay, this candle bottom of the wick is 22 pips, at the body is 18. Market's moving, so what we could do is wait a little bit, comes down to 30 something, and you can choose to get out there. If it's starting to pull back or bounce around, get out. Okay, you could do that. You're back to about 23 pips, so given spreads about 21, 22. But at any point in time, once you've hit, say, 20, 25, 30, take your entry, get out. This is where you're going to be consistent. There's been a lot of traders that have been very substantially in the money, and they've said, okay, this market's moving. I'm 30 pips in the money. This market's moving in my direction. I'm going to wait it out a little bit longer, and that's when market bounces back to possibly come back and hit the 50 or do something else for that time period, maybe consolidate and say even do a wick to the high or something like this. And that's when they start to panic, and that's what eats away at their trades, and they'll probably exit out of the trade themselves. Okay, um, just quickly, just looking at AUD JPY and stuff. If you take a note of where you would have taken your entries, the wicks on the top of them are either non-existent or very very small, right? That's the ideal sort of setup, and that's why we kind of wait. Don't try and fit trades in where it just doesn't make any sense. Okay, fit them in. If you don't have a substantial move throughout Asian session, London session, you probably will get it during New York session. So expect it. Um, that's kind of key in our strategy. Pound USD. Okay, zoom out. Let's see what the market's doing. Okay, this is another example. Same as AUD USD. It's not that clear. You could find structure. I mean, we can look at this and say, yes, the market came and did a multiple hits to the EMA 200, created somewhat of a double bottom formation, and then went up. But this is also like when you see a lot of wicks all over the place, this is a very scary trade for a lot of traders, because I mean, I personally would want to dump 10 lots onto that or 20 lots onto that, because it's, at this stage where you're here and you take your entry here, say for example, because you're thinking this market's going up, you ride it all the way up to that, you get your 20 pips, but at some point in time, this would have come out to be about 7 pips out of the money, which is about $770 or £770 out of the money. That would have freaked a lot of people out, right? So when you see this as compared to this sort of behavior, stick with this, right? This is again in the interest of consistency. Avoid it. ADJPY, one of my favorite pairs, but a very risky one as well. Again, this is a cross pair, so it takes a lot more analysis. If you're new to trading, if it's something that you kind of just not too sure about how to look at this, please stay away, because this is going to burn your account. What I wanted to show you on this one was where the market did. Remember, multiple hits to the high in this case. The market consolidated for a number of days, and then this I had. Oh no, this is my 618 line. Where price did go up, break it, and we're getting multiple hits to the high before it comes back down again, and it does this sort of behavior, right? So you could say this is somewhat of like a cup pattern formation, but what I did do was draw in my 618 line here. Price doesn't quite come back and hit 618, but I would have then taken that to say, after this aggressive move here, you could take an entry here. Maximum trade profit for me at this stage is EMA 50. Okay, so 29 pips or something along those lines. Get the hell out of there, because there's no guarantee that this market's going to come back down to the EMA 200. Okay, and also there's no guarantee that this is not a full cup pattern, which is going to pull back and then go boom. So this would have been like a handle that's created and then go boom. Okay, Pound JPY, this was another beautiful setup where we've got Thursday, Wednesday, Tuesday, Monday, where the market went up, consolidated quite a lot, did nothing. So don't look for a trade off of there. I don't know why I've got this line drawn in, but it did absolutely nothing for us. And then once it started to move, where we're getting the lower highs happening, remember, instead of, or we're taking this as a double bottom formation, but where could this realistically go? First hit EMA 50, second hit maybe EMA 200. Well, what the market did do was a double top formation. Remember, one tip to the 50 and the other one is not exactly at the 200 but close by. That is one of our confluence areas, right? So here, where would we take our entry? Would you take it anywhere here? No. You'd wait for this as well because the chances of market going back to do a retest of the 50 is very high. Wait, I wouldn't take it here. You wait for this bit to be hit, and then I'd probably consider taking an entry here, right? So taking an entry on that candle, 38 pips, I'd say, look, get the hell out of there. If you and also the reason why I would probably get the hell out of that, well, 34 pips, get the hell out of that candle here because we've just crossed the low of the Asian session and even the low of the London session. So what can happen in these cases is where the market can actually do another bounce and then come down like this. This could have so easily happened here. So once you get this, you get your 30 something pips, get the hell out. Right? CHF I've added that. I don't really trade it. Same thing here. You could have drawn in your lines here. I think I did. Where I'd probably do this. Actually, it's better to bring this here and wait for a candle to break below this point and close before you take an entry off the next candle. Okay, that's 23 pips on the one candle. 25 here. Yeah, you've got your 25, get out. So the potentiality just in the last 24 hours of over 100 pips was quite high, right? And so that's how you kind of want to take your entries. Wait for the simplicity. If the market's doing this sort of stuff, just stay away. Don't risk your money. And at the same time, just wait for the strong confirmation candles happening at the right time. London Open, New York Open. Okay, if nothing's happened, London Open, chances are quite high during New York Open, so that's when you can go in and do your trades. Okay, all right, guys. Look, really not feeling so well right now, so I will close off the video there. All right, all the best.